A Chinese billionaire has just placed an enormous bet against silver, roughly $300 million on the downside. The trader, Bian Enning, a famously quiet figure in China's financial world, previously earned nearly $3 billion riding gold's upside. Now, he has taken the largest net short position ever recorded on the Shanghai Futures Exchange for silver. That position represents nearly 450 metric tons, or close to 30,000 futures contracts. Silver's recent 16% price decline has already boosted the paper value of his position. On the surface, it looks like a perfectly timed move. But here's the part no one is connecting. At the exact same moment, this Chinese billionaire is building a massive short against silver. The Trump administration convened 54 countries for an emergency-level meeting on critical mineral supply chains and pricing control. Vice President J.D. Vance and Secretary of State Marco Rubio jointly hosted the Critical Minerals Ministerial, bringing together nations representing nearly 2/3 of global GDP. When officials use the term critical minerals, understand what that really means. This is code for physical silver, and President Trump has made it crystal clear. China will not be allowed to dominate or corner the global silver market. The global silver deficit is not theoretical, it is structural. And there are only 3 ways it can be resolved. Higher prices, increased production, restricted access to Western supply for China, and right now the Trump administration has fired all 3 weapons simultaneously. As I'm recording, current prices are as follows. Western spot silver around $70. Shanghai spot near $81. Shanghai futures near $99, with a Shanghai premium of roughly $11. Gold is trading near $4,808. Before we go further, I want to address the questions I've received about why I identified the $87 to $90 range as major resistance in paper silver. We saw 3 separate rejections at that level, followed by a pullback to the low 70s. If you want a deeper breakdown of the technicals, let me know in the comments. I'm happy to cover them when they actually matter. Not every video. For long-term investors and physical holders, I'll repeat this clearly. This is noise, but if you are trading paper markets, listen carefully. I've said this many times. If you are over-leveraged, oversizing positions, and trading without a plan, these markets will destroy you. Volatility like this demands disciplined risk management. Right now, everything is selling off. Stocks, crypto, metals, everything. If you're here to actually learn and you find value in this analysis, hit subscribe and drop a comment with OG John AG. Let me know if you want those technical breakdowns when conditions call for it. Now back to what really matters. At the ministerial meeting, J.D. Vance emphasized something crucial. Despite all the focus on digital assets and tech-driven economies, real physical commodities remain the foundation of power. He highlighted that the nations in the room account for roughly 2/3 of global economic output and stressed the urgent need for independence and self-reliance in critical minerals. Then he said the quiet part out loud. He stated that current global critical mineral markets are failing to create sustainable domestic industries or secure supply chains. He pointed directly at concentrated supply chains and persistently suppressed prices, distorted by forces beyond individual governments' control. Mining projects stall, capital dries up, investment becomes impossible when pricing is erratic and manipulated. The stated goal is to stabilize prices so domestic production can exist at all. The implication is unmistakable. The U.S. government has officially acknowledged, at the highest level, that current pricing mechanisms in critical minerals are broken and require intervention. Now, let's talk about physical reality. Australian bullion dealer Citigold has halted silver sales entirely due to a global silver shortage, not a demand spike, a shortage. India's MCX exchange raised silver margins by 7%, while gold margins rose only 3%. Exchanges don't raise margins when markets are calm. They do it when risk is rising. If gold were the problem, gold would be hit harder. It isn't. Silver is. High margins mean stress. Stress means positioning risk. Positioning risk means too many traders are trapped on the wrong side. They're not protecting investors. They're protecting the system. Now look at COMEX deliveries. Another 608 silver delivery notices were issued Wednesday alone. JP Morgan issued 531 and stopped 239. Total February. Silver deliveries have surged to 3,563 contracts, representing 17.8 million ounces, just 4 days into a non-primary delivery month. Gold deliveries remain strong as well, with over 3.2 million ounces already posted. Physical demand is relentless, and now the war signal. Silver is trading in backwardation, nearly 80 cents per ounce. Spot silver is trading above front-month futures. That means buyers are willing to pay more now than they are willing to wait. Backwardation does not happen in normal markets. It happens when physical supply is tight and urgency is extreme. Now zoom out. Crypto peaked at $4.3 trillion in October. Today, it's around $2.3 trillion, a loss of $2 trillion, nearly 46% wiped out. Bitcoin has fallen below its 2021 all-time high. U.S. equities are sliding. The Nasdaq shed over $500 billion in a single session. The S&P lost nearly $700 billion. Labor data is deteriorating. Jobless claims are rising. Layoffs are accelerating. Hiring plans are drying up. This is how economic weakness shows up first. Meanwhile, the U.S. dollar is collapsing at its fastest pace since 1980. Once the strongest G10 currency, it is now among the weakest. Why? Political uncertainty, aggressive trade policy, rising deficits, questions around Federal Reserve independence, capital is leaving, and where is it going? Into hard assets. Treasury Secretary Besant recently acknowledged reports that China is developing digital settlement assets backed by physical commodities rather than fiat currencies. China's actions confirm the shift. Gold reserves are at record highs, 74.1 million ounces, while U.S. Treasury holdings have fallen to their lowest level in 18 years. China has cut Treasury exposure by over $600 billion since 2013, while doubling gold reserves. This is measurable. This is deliberate. Every major asset class selling off at once does not happen in a free market. It happens under extreme systemic stress. And this is the core battle. Banks remain heavily short silver. Physical demand is overwhelming them. The coordinated paper smash in silver and other critical minerals occurred right before the 54-nation ministerial meeting. That timing is not accidental. While one side dumps paper contracts, the other side is rebuilding the entire physical pricing system. This wasn't just a meeting, it was a signal. While a Chinese billionaire shorts $300 million in paper silver, the U.S. is setting the foundation for price floors, domestic supply, and restricted access. When sentiment becomes excessively bullish, corrections happen, even in tight markets. And we've seen this repeatedly since 2022. But what matters is what comes after. Physical shortages remain. Dealer halts continue. Backwardation persists. Policy has shifted. The divergence between collapsing paper prices and tightening physical supply is the defining feature of this market. 3 takeaways. First, a Chinese billionaire has placed a massive $300 million short on silver. But the Trump administration has responded by coordinating 54 nations, acknowledging manipulation and moving toward controlled pricing systems. Second, physical shortages are accelerating. Dealers are halting sales, margins are rising, deliveries are exploding. Backwardation confirms urgency. Third, the paper smash was timed. Sentiment became crowded, leverage unwound. But structural forces remain intact. So the unresolved question is this. Does the $300 million paper short get squeezed as price floors emerge and physical shortages intensify? Or does deleveraging push prices lower one more time before policy changes overwhelm the market? That answer depends on time frame. Do your own due diligence. Understand the risks. Watch physical access, not headlines. If you can't take delivery, you don't own it. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.